Good afternoon, everybody. Thanks for joining us for today's webinar. We'll go ahead and get started here. We've got a few folks still joining us, but want to keep everybody on schedule for today. Thanks for joining us for the topic of the retirement plan changes. Dana and I will give you an update today on a number of different topics. Wanted to just make sure that we give a quick introductions here. So I'm Karen Sanchez. I'm the partner in charge of our benefit plan practice here at Sikich, and I'm glad to have Dana Howell, a director, on our team with me today as well. So well, it looks like both of our pictures are up here as well. You know, our makeup artist didn't arrive, today with the hair and makeup, so I'm just gonna have to get us as normal folks here today. But we gave you a little bit of information here about Sikich. For those of you who are not familiar with our practice, on our benefit plan practice, we will be kind of in the top 25 firms in the country that are providing benefit plan audits. We'll do about 450 audits this year. We really are doing all sizes, from startups up to those in the billions of assets as well. We've got clients in all states. We are heavily recruiting in Hawaii in the winter. If anybody knows of any of those as well, we'll be glad to show up there. But overall, Sikich also has, we've broken ourselves into various pillars. Dana and I are in the audit, accounting, and tax group. We also have a whole variety of advisory services to help with your businesses, as well as a large technology arm as well. There's about 1,000 of us here at Sikich these days, just under 100 partners, and are glad to have all of you with us here today. What we wanted to cover today with you is to give you an update of what's happening in the audit arena with respect to benefit plans, of the opinion changes that are finally coming around. They've been in the works for a number of years. Also covering some of the recent legislation. There has been a lot of activity, certainly from a regulatory standpoint in recent years. We'll do that at a high level. Kind of some of these are just reminders for things that came out several years ago, but may not still becoming effective and are on the horizon. And then Dana's going to walk you through some opportunities to enhance some internal controls in your organization to try to prevent some of the errors that we often find on the audits. It's opportunities to prevent some costly mistakes within the plan, limit your liability, and things of that nature. So Dana's going to cover through that, and we'll have some time hopefully at the end for questions. Certainly if we don't get to all the questions, you can feel free to still submit them, and Dana and I will get back to you after the presentation. So a couple housekeeping items first before we jump in. As I said, please do feel free to send us questions using the chat function on the panel, and we will probably hold those to the end to make sure we get through all the materials. We did include the PDF of the slides in the handout section. There is a lot of content in there. Dana and I get really excited about sharing all this information, so we might have been a little overzealous with giving you a lot of facts. I personally find it just helpful to have those things available as a reference after the fact. So don't worry, we're not gonna be here all afternoon reading you every slide, but wanted to give you some more background on things if you want to use those as a reference later on. We will also be providing CPE for you CPAs, or RCH and or HRCI credits for our HR friends in the audience. And so in order for us to provide those credits, we do need you to answer the polling questions throughout the presentation today. And we do need you to fill out the survey at the end, at the conclusion of the webinar, and then we'll be able to get those certificates off to you in a couple of weeks. In addition to the survey satisfying those CPE requirements, we do really value your feedback on what you enjoyed about today's presentation, what other topics you'd like to hear about. Again, we just enjoy really being a resource for our clients on how we can be more helpful. And your feedback helps us determine, how we can better bring information to you, whether if it's in things like today's webinar, or in white papers, handouts, newsletters, all those types of things. So we'd love to hear from you, your thoughts on what you would find most helpful. So jumping into the benefit plan audit opinion. So this has been in the works for actually a number of years. The rule was published final in July of 2019, but this has actually been several years in the making. For those of you who've read our audit opinions, they're a couple pages long, but many of you were doing limited scope audits where we're not auditing the investments, and it just doesn't read, quite normal if you're used to reading audit opinions. It essentially says we disclaim on your audit because we were not able to perform certain procedures, which isn't really reflective of what the audit is doing. It's certainly an acceptable opinion to the Department of Labor, but we get a ton of questions on it. So we're happy that we're seeing the standard finally coming to fruition and being in a format that's going to be more meaningful as to what we perform, within the opinion itself. So originally the standard was supposed to be effective for the calendar year plans that we're working on right now. And then with COVID coming in, it had actually had a deferred effective date on that. So we'll be implementing it for our calendar year 2021 plans. But we wanted to give you a sneak peek as to what things will look like for next year as we send out next year's engagement letters, and so we can be prepared for some of the changes that you may encounter next year. So essentially the words limited scope will no longer be used, and it's replaced with section 103A3C opinion. It would have been nice if we had an easier name to say, but we're all going to learn that section soon enough, and limited scope audits will become a thing of the past once we all get used to the new nomenclature for that. Essentially what it does is it implements a number of new performance requirements relating to what management needs to do as well as what auditors need to do. Many of these things you really won't see a lot of changes on, other than some of the wording and the correspondence that we'll need to do. You're going to have, management will need to specifically acknowledge certain responsibilities, things like maintaining a current plan instrument, really things you were doing all along, right? You were always responsible to have your plan document, monitor the plan, maintain records. Some of the things, though, that'll be more prevalent will be that management will need to specifically indicate that you have a valid certifying entity and provide specific representations with regard to that the custodian or trustee that you're utilizing or insurance company meets those conditions. We also need to determine what's audited or what is provided under that certification or not. Sometimes, for example, participant loans are not covered under the certification. Sometimes a brokerage account is not covered under that certification. So we need to just have potentially more clarity surrounding some of those areas. There's also just different requirements regarding certain plan provisions that we need to look at. Many of these things we always felt were just essential to performing an audit. So on our end, things aren't going to change significantly, but others in the profession may not have been auditing to the sufficiency of what the Department of Labor was looking at. We've always audited eligibility, vesting, contributions, all of these areas we felt like were an important part of the audit. It specifically talks about definition of compensation. Actually, a lot of these things are things that Dana's going to cover in her presentation about the importance of having controls over these areas. So it's just really emphasizing more and creating more visibility of what should always have been happening in the audits. There will be new requirements to issue more reportable findings in writing to those charged with governance over the plan. So again, another important part of Dana's presentation today is making sure you're familiar with the controls so that we don't have things that we need to report and indicate as reportable findings going forward in the audit as well. Essentially, what we communicate to those charged with governance about non-compliance with things will be more prevalent in things going forward, and just kind of raising the bar of what we were required to do in the past. We also will need additional representations from management. The letter we have you sign at the end of the audit, you're going to see some changes in that in the language as well. Again, specific representations about that you're maintaining your plan and you're administering your plan appropriately, and that you can do the audit and this information is certified as well. And also specific representations related to the supplemental schedule that were not included before. So essentially your engagement letter is going to look different, your opinion is going to look different, and your representation letter are going to look different. One of the standards also says that we have to review the 5500 before the audit's completed. I always found it very challenging to ever issue an audit before we read the 5500 for which our audit needs to match and be in alignment with, since an attachment to that. So again, we don't anticipate much changes on our end there. We did want to give you a sneak peek as to what the opinions will look like. So full scope audits, those where we're not carving out the investment activity, are also going to look different. They've rearranged the format to emphasize not only the auditor's opinion, as well as all these expanded responsibilities of management, as well as the auditors are listed. So this isn't intended to be a reading or an eye exam here, that you're intended to read all the language here, but it's a snapshot as to the length of the opinion. If you were familiar looking at it before, you were really more of a 2-page. Now, we didn't get shorter with our wording, we got longer in it. And again, just additional detail under each of those categories. So you're going to see a much longer, more detailed opinion going forward on the full scopes. Similarly, on the new limited scope, or the 103A3C audit, there's actually going to be a 2-part opinion now. We're going to say what information is covered under the certification that we did not audit, and we're going to say what we did audit. So our opinion is actually a 2-part one in the new format. And this is the format of the new limited scope audit. So definitely a lot more wording that's going to be included in the format of that. And in that first year, we're going to have the that whole opinion that we just talked about, and then you're going to have the whole old opinion, because we need to still follow the language of what we issued in the prior year when we're presenting our comparative statement. So your opinion is going to be fairly lengthy in the calendar 2021 audits because of the dual opinion, and then we'll just continue to be longer kind of from there on out. One thing that does relate to this year's audit that we wanted to bring to your attention is that I mentioned that the new opinion type was to be effective for 2020 audits. In conjunction with that, the Department of Labor reprogrammed their system for the 5500s for 2020 to accommodate the new language. So this is an excerpt of the accountant's opinion section of the Schedule H that you'll see on your 5500. You'll notice that if you look at item 3B, you know, this now references the ERISA 103A3C language, of which we're not implementing for this year. So the Department of Labor has provided unofficial guidance. We haven't seen anything in writing, but we've heard from a number of the officials there that their recommendation is that if you continue to do a limited scope audit for 2020, you would actually mark the unmodified box. If you remember, we always marked the disclaimer box in the past. So they're recommending that we mark the unmodified box because I believe they've reprogrammed their systems that a disclaimer of an opinion would typically be more of a red flag. And then you'd mark this first box that you're doing the audit under this regulation here as well. So that's how we're going to be recommending that the 5500s be completed for this year. The Department of Labor did say they seem to be understanding of the challenge with this transition, and hopefully are not going to be sending out a lot of notices surrounding that. And if we do have a notice, we'll just be explaining what it is that was done versus hopefully creating some higher audit risk or something of that regard. So they're well aware of the transition issues as well, and hopefully we will not see problems encountered with that. So that's a little bit of the new audit opinion. So wanted to go through the first polling question here. Wanted to know, do you have written internal control procedures relating to your plan operations? So that would be yes, no, or unsure. So we'll give people a chance here to respond. And if you're not sure what that is, Dana will be covering that shortly in her part of the presentation with regard to some recommendations for what those procedures are going to be. Just a little hint for those of you who were doing your audit with Sikich, many of the things that we guide you through and help with the questions about your procedures may be helpful in that regard. See, I'm not seeing the polling questions popping up here, the answers. Dana, are you seeing that pop up on your screen? I think they might have told me that might not be on mine.
Yeah, they just closed it, and it says 53% said yes, 20% said no, and 27% unsure.
Okay.
There's look like there's 47% of the people listening that I could help. We could help.
Stay tuned. We'll get to that part shortly then. So thanks, Dana. So we'll go through. I wanted to give you again an overview of where we've gotten in some of these regulations. The first one that we were going to talk about is the Secure Act that came out on, so I went through the date. Back in December of 2019, the Secure Act was pronounced. For some reason, the government always likes to put these out right at Christmas time. Happy holidays to read all the new regulations, but must be their sense of humor a little bit. But anyway, so the purpose of this act was really to come out and ensure that people were saving enough money for retirement. And you'll see the theme here of everything being opportunities to get people to save, how to get people more engaged and make sure that retirement plans were available to everybody. So with that, they created the expansion of multiple employer plans. It becomes an opportunity for primarily smaller businesses that want to kind of get some efficiencies of cost by bundling together with some other unrelated plans to ideally receive, reducing some of their administrative costs. There's a lot of pros and cons with these, and there's a number of these that are in the midst of being created now that we're in 2021. So this is anything you guys are interested in, we'd be glad to talk with you more about pros and cons and whether or not it makes sense for your plans out there, or you're probably working with your investment advisors on those issues as well. Just wanted to make sure you knew that was out there. Historically, you've always had to adopt a retirement plan before the end of the plan year that you wanted to have it for, so that if you wanted something in effect for 2020, you needed to adopt that for 12/31/2020. The Act actually allowed you to now retroactively adopt plans even after the end of the plan year if it's before the extended due date of the return. So we've got some clients now that extended their business returns and are still in the process of adopting plans retroactive back into 2020. So it's sort of an interesting development for creating that opportunity for employers that in the past you needed to make that decision much sooner. One of the things that's been on the horizon is that plans have to offer eligibility to long-term part-time employees. So those employees that have worked at least 500 hours per year for the past 3 consecutive years actually have to be offered the opportunity to participate in the plan. So in the past, we've always kind of had this 1,000-hour requirement that you could carve people out of the plan and they weren't eligible if they're part-time working less than 1,000 hours a year. Now that's moved down to the 500 hours. Again, wanting to allow more of the workforce to have the opportunity to contribute. This becomes effective in our 2021 plan year. And this is where employers need to make sure they have a process to be tracking what the eligibility is for this portion of your workforce to make sure it's offered at the appropriate time. It does give you some relief from some of the non-discrimination rules. You're not going to be penalized because you're offering them the opportunity to participate, and you don't have to give them employer contributions. You just have to give them the opportunity for them to make contributions, into the plan. But again, from an administrative perspective, you have to know who these people are and make sure you're offering them that eligibility. So you want to make sure you've got a good tracking process in place. I know a lot of the record keepers are incorporating this in, but you want to make sure that you're uploading your full census to those record keepers so that they can be maintaining the tracking for this for you and to be prompting you to offer eligibility at the appropriate time. Also, if you're changing record keepers during this window, making sure you've got a process in place that those hours were tracked for years, prior to your transition over. So it's creating some more administrative time to make sure you're covering, again, this part of your workforce. So that's something that, employees or employers in certain categories that have a lot of part-time employees need to be aware of. This also could cause plans that previously didn't need to have an audit that will need one now, because if they went over the 100 eligible count, now including their part-time employees, they'll be subject to the audits going forward as well. So depending on if this is impacting your workforce with a part-time employees, definitely something to look at and make sure you've got a tracking place, because that is now effective in 2021 in terms of making sure you know what hours even your part-time folks are working. For those plans that had automatic enrollment in the past, you could only you could only have do auto enrollment up to 10%. Now you can bump that up to 15% if you want. Also, we had some more flexibility given to non-elective 401k safe harbor plans. These are the ones where it doesn't matter if your employees contributed or not in the form of a match. This is you're just giving a flat amount, probably 3%, to your workforce if they meet certain eligibility. So the IRS came back and gave you more flexibility to amend the plan, within the year, or rescind that within the year if you meet certain conditions. So some welcome changes on flexibility for those plans. The movement in retirement plans is to help participants. They've saved up all their money, but also to help them plan for the outflow of money in retirement. And so the Department of Labor wants to have more visibility into annuities and lifetime income options where participants can buy that product, and it will pay out money for a certain stream. And so there's legislation that's going to require more of these disclosures to be given to participants. This is something that's really still in development, and there'll be a year window for record keepers to be updating all their disclosures and benefit statements after, you know, some of that, the rules come out and what it looks like. So again, something to help participants plan for how to spend down money in retirement. If you wanted to, you could also have childbirth or adoption withdrawals. That would be penalty free, still taxable, but just another exception to that. That's something you could have adopted. We had a number of changes in the required minimum distributions. As longevity improves, they've moved the 70.5 date that's been around for a while to 72. We also saw some suspension of this during the COVID period as well. But going forward, you know, 72 is going to be the new young. The 72 is the new 70.5 going forward with regard to that area. So then we had all these provisions put in place to help people save for retirement, and then COVID came along, and so in March of 2020, the IRS said, oh, well, instead of saving everything, let's get cash back in people's hands who need that due to changes in the workforce or medical issues. So the IRS gave us the provision that said that if the participant's spouse's dependents were diagnosed with COVID or they had a financial impact as a result of that, they would have been eligible for these provisions should the plan sponsor have adopted these things. So these are things that you as a plan sponsor chose to adopt or not adopt during the year. So making sure you have your information as to which provisions you chose to adopt and operated during the current year. This came around very quickly, so there was a lot of confusion for a while. In terms of that, it also on participant loans really allowed you to give up to $100,000. That was up to a certain date that those loans could happen, and then there was flexibility for repayments not happening in 2020. On this point, I would make sure that any of your loans that had deferments have been restarted in 2021 and have all been properly amortized. We heard a few of little quirks of things not working out exactly right with some of the transition of getting those started again in the current period in 2021. So plan sponsors could also have allowed participants to take up to $100,000 out of the plan, not subject to the 10% penalty, and on their individual returns, they could be choosing to spread that tax over a couple of years, over a 3-year period of time. Again, all that was really handled on the 1040 level, not at the plan level. And there was an opportunity to also repay that back into the plan through a rollover function. And again, they would handle all the tax consequences on their individual tax return associated with that as well. So again, kind of keeping your documentation now, remembering, you know, which provisions you guys adopted or chose to adopt on those, because it was not all inclusive. You could kind of go through a checklist and choose if you were going to allow everything or just a certain portion of those. We're anticipating that the amendments will happen sometime in 2022. We'll see if they follow the timing of what the IRS put out on that. Defined benefit plans also receive some relief for the year and for the ability to pay some of those contributions at a later date, as well as deferring some other changes that need to be happening for them as well. So we'll go to the next polling question. So if your plan did adopt these CARES Act provisions, did your participants take distributions or loans out under any of these provisions? So the questions would be yes or no, or we did not adopt any of the provisions, or we're unsure. So I'm going to ask my phone a friend Dana to help me with the results again when they come up.
The poll is still up, so we're not quite.
I think from what I've seen so far from plan sponsors and in the planning meetings we've been having is that there's a few people that took them out, but we didn't see a significant cash outflow. So it sounds like the PPP loans that many employers had or other things that were put in place kept a lot of people in the workforce, or they had other resources that they weren't having to significantly draw down on their retirement. And I know on some of the board meetings I've sat in on with record keepers, you know, presenting, and they talked through across their participant workforce, they were seeing a fairly low amount of withdrawals, which is good to see.
It looks like on the polls, yes was 36%, no was 19%, 33% said we did not adopt CARES Act provisions, and 12 were unsure.
Okay. All right. Thanks, Dana. I think one of the things we'll talk about later is just making sure you're kind of monitoring, having good control to monitor cash outflows out of the plan, making sure that the loans and distributions that are going out of the plan seem reasonable. You're not seeing significant distributions by people that are fully employed and wouldn't have had a reason to be taking money out of the plan. One other provision that came out in December of 2020 was some help with regard to partial plan termination relief. So just as a backdrop, if you were to terminate your retirement plan in its entirety, all participants would become 100% vested. So similarly, the IRS says if a significant portion of your workforce terminates, those affected people should also become 100% vested. And the IRS defines significant as maybe 20%. It's a very fact-intensive determination with a lot of court cases back to support when it is, when it isn't, things like that. But we want to make sure that the plan sponsors are evaluating this so that if you had a large number of forfeitures, you're evaluating it now to determine whether or not those participants should have their forfeitures restored. What you don't want to do is several years down the road, realize that you're going to have that question and need to address that. The IRS, in response to the challenges that many employers had during 2020, said, well, if from March of 2020 to March of 2021, the average, the active participant count is at least 80% of the number you had a year ago, then even if you took a significant dip in your workforce during this 2020 COVID period, you won't have been considered to have a partial termination as long as that head count's back up to an 80% number. So they gave us some flexibility if you had some temporary layoffs and you've kind of gotten back to at least that 80% level. So this is another, if you're evaluating an opportunity, just don't just look at calendar year 2020, roll forward a bit and say, how much of your workforce did you restore by March of 2021, and how that impacts this decision here as well. The IRS does know what information happened on the plan. They use the 5,500 participant counts. What was the numbers at the beginning of the year, the end of the year? There's a question on there that says how many people terminated less than 100% vested. And they do send out inquiries. They're usually a couple years down the road, but it'll send out inquiries to say, answer all these questions because they want to help make the determination whether or not this occurred. So those things can be certainly challenging to answer, in the future. So we are just encouraging everybody to take a look at things now and make sure that they've made their determination as to whether or not they need to restore any of those forfeitures right now, so that you can respond to any inquiries that might come later on this issue. Just quickly on some DOL guidance that came out in April of this year. Clearly we all saw a lot of cybersecurity things happening, and if you're in Illinois, we had more unemployment, crazy, fraudulent claims. I don't know if we got the record on that, but we certainly had our share of, those types of things happening. The cyber criminals certainly use this disruption as an opportunity to do all sorts of phishing scams and schemes, along those lines. So really, we just want to create visibility as it relates to the retirement plan. Some of our participants don't log in regularly on that. They don't monitor their accounts. So we want to make sure that plan sponsors are keeping their training update on making sure they're doing their best at any cybersecurity things, certainly within the organization, as well as advising participants about their plan. So in response to this, the Department of Labor came out with some guidance on April 14th. They created a number of different publications with guides or tips for monitoring your service provider, including one that has strong cybersecurity practices. So we always ask you in our audits about, did you review the SOC report of your provider? Well, some of a lot of that is their IT controls over a number of areas. And so now the Department of Labor is just re-emphasizing that part of your fiduciary guidance is to make sure you're monitoring that service provider, understanding what's happening at that service provider. Do they have errors, issues, on the technology side of things? They also provide some cybersecurity best practices, some online security tips. And essentially one of these is a guide for participants who, what they should be doing to prevent the risk of fraud or loss. We have seen court cases come out over the last several years about participants who lost money, and they're, saying, well, who's going to pay me back? Is it going to come from the plan sponsor? Is it going to come from the record keeper? So that's somewhat of an emerging area in terms of who all has the liability, but I think it comes down to what steps did you take to monitor and oversee and attempt to detect and eliminate some of these risks and threats. One thing you could be doing is looking at, again, the distributions. Do they look reasonable coming out? Does it look unusual for a certain participant to have taken money out of the plan? And also encouraging your participants to be monitoring their accounts and safeguarding their passwords as well. So I gave you the link here of where some of those notices are at in order to gain access to any of those. We also do have a cybersecurity consulting team that can help with a lot of these different areas if you need help. Those of us like myself who are not all that technology savvy know it's a problem, but just need to know who to get a hold of to help navigate that process. So we'll go to the third polling question. Does your company have a formal vaccination policy in place? Yes, with an incentive, or yes, without an incentive, or no. We have one in the works. We're currently evaluating one, or we're unsure. This one we gave you a whole lot of options. It's certainly an emerging area. It's interesting to see how it's evolving and how companies are going to respond to this, and then really what some of the subsequent litigation is going to be with regard to actions that employers may have chosen to take, and how the employee workforces are going to be responding. So we're seeing all sorts of different things that employers are doing to try to monitor this area as well. So I'll give you guys a few minutes to answer, and then I'm going to be turning the reins over to Dana as we get through this polling question here as well. So I think, so we said the responses were 1% that said yes with an incentive for vaccinated employees. 8% said yes without an incentive for vaccinated employees. So we've just got 9% that's requiring. By far the majority said 75% are saying no. 8% are working on a policy, and there's 9% that are unsure, kind of evaluating what they're going to do in that regard. So I'm going to let Dana take it from here and talk about some of the controls or opportunities of what we can do to prevent some of these problems. Dana, do you want to kick it off?
Yeah, thanks so much, Karen. So I know that as hopefully many of you sat in on our fall session. And in our fall session, I talked a lot about different errors that we find in benefit plans, and how, the importance of monitoring, and how, not just because it's important to do, but how it can really cost you as a plan sponsor, money to correct these errors. So we're kind of going to start with that basis and kind of grow it to take it to the next level, and just talk about, how, what can you do as the plan administrator and keep a lot of these errors from happening. Now, why does this matter to you? You're probably saying. As the fiduciary, it's as and that the fiduciary, you may not say, well, I didn't sign up to be a fiduciary, but inadvertently, just by being a plan sponsor, being
Hey,
the plan.
Dana.
Yeah.
We can't see your screen right now. Can you make sure that you're sharing the presentation?
Sure. It shows that I am.
Sorry, everybody, technical difficulties. Give us a
That's because I
second.
use the word technical difficulties when I say cyber. Let's just say it's the cyber criminals that are coming in and doing this. There we go.
All right, now we can
There
see
we
it.
go.
Thank
Sorry
you.
about that, everyone. No problem. Thank you for telling me that. I did not know it wasn't showing. So sorry about that. So again, for fiduciary responsibilities, just by being the plan sponsor, the administrator, and, also wherever your funds are involved, you are considered a fiduciary. And what the importance of that is, you have the responsibility to do what's in the best interest for the plan. And if by some chance they found that you did not meet those duties, you could potentially be personally liable. if you did not follow those. And, some of the basic responsibilities are maintaining the financial books and, filing complete and accurate annual Form 5500 returns, but also, one way, the best way to protect yourself is by implementing internal controls over the activities of your plan. And that's, when these internal controls are effective, it gives more assurance that your plan is actually achieving its financial reporting objectives. So what does this effective system of internal control? And there's really two main types of controls. We're going to briefly kind of give you the backstory and then to know how it can apply to you. So really, there's preventative and then there's detective. And for preventative, it really is just you put something in place, so no matter what, this can't happen, right? And then an example of this is, most people they outsource their payroll, or even if they use an internal payroll processor. There's controls that are built into your payroll system so that someone cannot go over the contribution limits that are imposed each year. It's $19,500. So most payroll systems have something that says once it hits 19,500, nothing else gets withheld, nothing else gets, contributed. So that's a preventative control, where something that you put in place to kind of stop someone from contributing too much. Another is, there's a max compensation that can be used, setting that in place so that the deferrals or the employer match are on the correct type of compensation. Sorry about that. On the flip side, detective is really something that is put in place to help find when there's an error that happens. So it's going to be something that someone has to do. And, when we talked last year, errors happen all the time in plans. Everyone, the IRS and the Department of Labor understand that, and they have these programs in place to kind of help you, protect you, so that the amount that you have to contribute to correct is lower based on when you found the error. If you find it sooner, the amount you're going to have to pay is going to be a lot less. So these detective controls are designed to really help find that more timely, so that if there is something that goes wrong, you don't have to pay as much to correct it. So internal control, we all know about it. It's a process. It's something that is impacted by personnel. It's designed, to provide assurance that if I put this in place, then something is going to, protect whatever it is whatever asset or information I'm trying to protect. And it's a multifaceted in that, it deals with the physical security, your organizational design, how many people you have. If you have multiple locations but all payrolls at one place, your control's going to be different than if you have multiple locations that each do their own payroll. So these are all different things that, as you're looking at internal control, that you want to identify where there could be weaknesses. Or is the personnel qualified to perform their assigned duties? And are they actually being, if you have these controls, are they actually being monitored and being administered are they happening as you want them to? So this next one, establishing cost-effective internal controls. I'm sure everyone knows about segregation of duties. That's kind of the main go-to when you think about internal controls, segregation of duties. And I know during this past year and even right now, within your organization, you might have seen a decrease in staff, whether it was something you had to for the downturn in the economy during COVID, or maybe people left and now you're having a hard time replacing them. So when I'm talking about cost-effective internal controls, especially with your plan. I really want to look at things that aren't going to cost you money, aren't going to take you a lot of employees, and something that can really fit within your organization. Because as we go through this, you'll see that there's some really basic items that you can put in place and that aren't really going to take much time or manpower to do those. So but even when you're looking at that, you need to make sure that it's risk oriented. We're not going to spend a lot of time trying to make a good internal control over, passing out enrollment forms. Now, most of the time everyone's, completing online enrollment, so that isn't even a factor. But so that's kind of where you look to see what's the biggest risk. And so with the items, with compensation and properly calculating deferrals, those really are going to be your main ones that you're going to want to take a look at within your organization and say, okay, what are we doing? And is that enough? As we talk about internal controls, your control system in place is only as good as how it is documented and communicated. So if there's anything you take from this, I want you to really make sure that you try and have something written down, something in place. And when we talk about establish and document and communicate, you should first start with, what are you currently doing? It's kind of funny in the sense that, we'll ask someone, we'll give them, what is your process for this? And then we may give it to the CFO, and the CFO will say, oh, well, we do this, this, and this. And any changes in pay rates are double checked by the HR manager, and they sign off on those. And we review to see who has access. And so we document this. And then when we go to actually test to see if those controls are actually happening, and so then we go to the HR manager and they say, we've never done that. So, you want to start with what you're actually doing with the thought of where you want to move to. So you don't want to say what you want it to look like. You want to say, well, this is what it is. And you want to talk to the people actually doing it. You want to go, who's doing the payroll? Who is letting people know that they're eligible to participate in the plan? So you really want to find out from the people actually doing the work, document that. And then once you establish, what the controls are, you want to document it with those people, let them have the input. Staff training, it really is a key element in ensuring the effectiveness of the plan's internal control. You want to make sure that everyone is on board and everyone's buying in with everything you're doing. Monitoring, internal controls, you can put a control in place, but unless you're making sure and testing to make sure it's effective, it's not gonna work. So you want to make sure that you are checking to make sure that whatever you say is, if so-and-so, if the HR manager is supposed to be reviewing those participant, change in rates, pay rates, that they are actually doing that. Now, again, with monitoring of these internal controls, these are the questions you want to be asking. Are they in place and operating? Is the system working as designed? Are exceptions and problems identified and resolved promptly? Internal controls aren't something that you're going to write and walk away from, that are never going to change. A lot of times it's because something's happened and you realize, well, that happened, and now we need to look to see what we could have put in place to ensure that doesn't happen again. As we do these audits, perform them on our end, I always say, I'm not perfect. We don't expect you to be perfect. And if we find an error, let's figure out what caused it to happen, and then what controls can we put in place to prevent that. And then we'll get into some of those details. So as many of you say, why do I really have to worry about internal controls? I outsource, ADP does my payroll, and principal holds all my plan assets. So there's really nothing I need to worry about. And the one thing I always like to remind people is you can delegate tasks, but you cannot delegate your fiduciary responsibility. So it is still, even though you have these service organizations, you really need to make sure that you have the right service organization in place, but B, that they are doing what you expect them to be doing, and to ensure that they have those in place. Like Karen said, most of these service organizations have something called a SOC report, which is just basically an outside audit that's going to review and test their controls within their organization. So you always want to make sure if you do have these, you want to make sure you get those SOC reports, you read it to see if there's any errors that were found, and then you also want to look at there's end user controls that you need to have at your own organization in order for their controls to be running smoothly. So I keep talking about these top operational errors and this slide is exactly the one that we did in the fall. These are the top operational errors, not just that they happen a lot, but these are the ones that cause the most corrective items where plan sponsors actually have to pay additional money into the plan. It's incorrect definition of compensation, incorrect employee deferrals. So that is basically that where it's not following the employee's election. Incorrect employer contribution, note receivable payments not started timely, contributions not timely remitted, and incorrect distributions. So we're going to take these now and we're going to look and hopefully give you some guidelines to help you within your organization on how you can have some controls in place to help make sure these errors don't happen to you. So the first thing you should always do with the control is actually state what is your objective. So all of these I've kind of put in place. I'm helping you start to write your control narrative if you did not have one. And the first control objective for contributions is contributions are recorded at the appropriate amount and in the appropriate period on a timely basis. So if this is our control objective, it's going to cover the incorrect compensation, employee contributions, not meeting the deferrals, and also on the employer match side. So some controls, and these are kind of general, not as specific, but inputs to contribution are compared with compensations defined in the plan instrument. Contribution payroll records are reconciled to the trustee custodian. So the one thing, if you have one person and you wear multiple hats, you're the controller, you're the HR manager, you're kind of everything. One thing that you can do is know your definition of compensation based on your plan document, and then look within the payroll and make sure all those items are properly included or excluded when the deferrals and the match are being calculated. On each pay, that next line with the payroll records reconciled to the trustee, what was withheld from payroll, is that the amount that matches? You can do it, it's easier to do it on a per pay basis, but at minimum, you should take your year-end payroll summary and compare what was withheld from your employee's pay and what was deposited into the plan. Now, you may have a receivable based on timing of payroll, but you should be able to match those amounts out. So these, again, are different controls that would help you achieve that objective. Now, again, these are taking those control objectives for contributions, and what if I have a service organization? And the service organization is going to be, again, it could be payroll or it could even be your trustee. So you want to and these again are just very general ones that you could have, and then example controls. So whenever you have a service organization, Karen made reference to, the notices that are given to participants. So, most of the times everyone receives a quarterly statement. We do for our plan, and that's basically everyone should be getting quarterly statements, whether they're mailed or they're uploaded to their online account. So that is one example of a control, but that is, you don't have to do anything with that, is actually already available for you. And then the other is, the plan administrators have policies or procedures that provide reasonable assurance. Well, these are kind of basic. So it's, what exactly does that mean? And so as I said before, we talk about that the plan administrator has policies and procedures. Well, here's some specific procedures relating to the proper definition of compensation. And, annually you review pay codes to ensure compensation and operation matches the plan document. You may see, a lot of times we'll ask, were there any new pay codes added? And they'll say no. Well, what about people don't realize for this past year there could be a COVID pay code? And we've already seen on some of the plans that we've started auditing, I don't know if they used, it was one of either Paychex or Paycom, but they were the payroll entity themselves were not sure how COVID pay, if it should be have withholdings withheld. So for the first pay, they did not withhold any deferrals. And then, so when we're auditing, there was a difference, and some people had deferrals taken out, some people did not, of their COVID pay. And in doing more digging, and the client, they knew there was this new pay code, but they thought it was set up right. And here, because when they checked it at the end of the year, it was right, but then when it was first initially set up, it was not. So that's something that you need to think about. And then this third one, limit access to those who can make administrative changes. If there's one control everyone should have in place, they should be monitoring who has access to their payroll and who has access to their trustee or custodian, because just by checking that, you can see who has access. People should not be sharing login information. Each employee should have their own, and when they're terminated, it should be documented, and they should have their rights removed. And that's one of the key items to make sure that people are not able, anyone just can't have access to the system. For the deferrals, you want to make sure the authorized pay rates are communicated to the payroll processor and they're reviewed after initial entry. Same thing with hours worked, that they're documented and approved. If you have one person entering, periodically check. There's 5, if you can do something also at the end of each year, pick 5 people. And of those 5 people, check to make sure their compensation is right, the hours, the not just in total, but based on the definition of the plan, but also their pay rate. Check their pay rate. Are they being paid what they're supposed to be paid? And then their deferrals. Look to see how their deferrals, what they set up for percentage wise, and not just percentage wise, but again, Roth versus pre-tax. And a lot of times everything is done online, and somehow though there's a notice that goes to someone within your organization when someone does elect a change. You want to make sure more than one person is receiving that notice. And it could be, and just by having that second person, and that second person periodically going in and checking, hey, I got a change notice for Karen, I wonder if that was put in, and going in and checking and documenting that, that in itself, just checking to make sure things are, being processed timely. And again, you can see here limiting access to those who can make administrative changes. Again, if there's one thing that checks lots of boxes, it's limiting and monitoring who has access to what within your organization. For the timeliness of contributions, making sure that deposits are reconciled to payroll and reviewed prior to remittance, but also annually, what was withheld from payroll, what was contributed to the plan, both mainly on the employee side, but if it's monitored also in your payroll for the employer contribution, but if not, what was actually paid into the plan, and was that amount actually deposited? That takes one person to do that. It doesn't take multiple people. And you just want to make sure, if you do have one person who handles the contribution, making sure the wires are going into the plan and someone else is reconciling the bank account, you know, that's a nice, if you do have the power to have segregation of duties, you know, making sure emailing whoever is doing the bank reconciliation each time at the end of each pay, just the summary page of how much is going into the plan so that they can check to make sure that the amount that was supposed to be paid is what came out of the bank account. For notes receivable, again, the main risk for this is that loans aren't starting, that the repayments aren't starting timely. You know, everyone typically has to have a signed form or they have to have an election that they requested online. Well, how is that notice and that loan payments are supposed to be started communicated back to you, the plan sponsor? Just like with the deferral changes, that should be going just to 2 people if possible, even if it's just, you know, the president and then the person who wears all the other hats in the organization. Just having that oversight that someone else is aware and checking in is perfect. And then again, I'm harping on reviewing the year-end statements, but this is really another one. You know, loans payments are typically processed through payroll. So as you're making sure the employee and the employer contributions match, how much was withheld from a participant's wages for their loan payments? Is that how much that was paid into the plan? So that's a nice little check the box that, you know, as when you're already doing it, that shouldn't take much time. And if there's a difference, why? You know, ask the TPA or your trustee custodian. Also, you can take a look at the loan report that's from the trustee. And are there any loans that don't have payments? That is a red flag. Like, wait, did these not get started or what happened here? So just reviewing to make sure that, you know, any loans that didn't have payments, that it was defaulted and, you know, they were deemed distributed from the plan. For notes receivable, again, these are additional controls that you can have in place that I kind of already talked about, just about that the records are reviewed periodically for past due and that you're reconciling cash disbursements from the payroll to the trust statements. For distributions, you know, you want to make sure that the person who actually authorized the distribution is that participant. So you want to make sure that, you know, the changes, how is principal made aware that this person was terminated? You know, it's going to be at your organization, so you want to make sure that the information provided for a termination date is timely communicated and approved and provided to the third party administrator. And then also you want to make sure the participants' benefit and cash are controlled to prevent or detect on a timely basis unauthorized or duplicate payments. You know, one of the main items with this, which we'll go to the next one, most service organizations, they handle all distributions, at least for most of my clients, they do. So the participant logs in through their unique online account and requests the distribution. So this is one where you really want to look at the SOC report for your organization to see what user controls you're responsible for. And again, the control, because you have a service organization, one of the main controls, you know, confirmation notices and quarterly statements are provided. You know, you might want to check to make sure that confirmation notices are being distributed. So anytime a participant has a change, they're notified so that if someone did, you know, that wasn't them requested distribution, that would be in place. Some of the other items and controls, you know, to ensure that relates to forfeitures. And in talking about forfeitures, you know, the 2 risks for forfeitures is one, that they're not being used to offset employer contributions. For not-for-profit organizations, it's not as important just because it's not, you're not paying taxes. But for the other one, it's using the forfeitures to offset administrative expenses. And if there's a large amount in the forfeiture account and I'm being charged $100 annually for the maintenance of my account, you know, that's something that I could go back on and say, I shouldn't have, they should had forfeitures that they should have used. So the main thing with distributions is just really making sure that forfeitures are being used appropriately. For participant data, there's nothing really new here in the sense that these are all kind of covered. If you go through these, they're kind of covered with what we already talked about in the contributions. You know, you want to make sure that they're reconciled, reports are reconciled. The only different thing is that your participant data is reconciled, you know, basically your counts. So you can look at your counts and say, how many active people do I have on my payroll that are making contributions to the plan versus how many do my record keeper, my trustee custodian have. And again, for eligibility, it's going to be the timely, how is the communication going on? How are you made aware that someone has decided to start contributing? It's going to be the timeliness of getting those deferral changes when you're notified of that change into your payroll system. For your records, this is again, access to the participant data is controlled to prevent unauthorized changes. Who has access to payroll? Who has access to log in to initiate any of these, to saying that someone is allowed to participate in the plan? And then for service organization, these are, again, the main objective is, you know, you want to make sure that they're processing the information accurately and on a timely basis. And so, you know, you want to make sure that all of these items, that confirmation, you're being made aware when contributions are being made. You're being made aware when participants make election changes, when they want to take a loan from their account. And these are all just still additional various objectives. So, you know, when you're going through, the main thing you want to, again, you want to look at your accounts and you want to see your processes, who's doing what, and you want to say, well, these are what I have, and this is my process for maintaining it. And then the one way you can check is by just picking 5 people every year. Is my hour right? Is my start date, my birth date, rehire date? What is my compensation? What should it be? You know, you want to do all of these are things that you can do either on a quarterly basis, annual basis, and that you can catch hopefully anytime that there is an error. Now, for reporting, these go along the same. This is just a summary then, you know, taking instead of just on a participant level, what's the big picture? And the big picture, you know, you want to tie out your contributions per payroll to match the trust. You want to make sure your employer contributions also match. Same thing with loan payments. Who took a new loan out? Did it come up over into our record keeping book? So these are all different things that we should be doing under best practices, so that hopefully if an error does happen, you know, you're able to catch it. Again, if it's a lot of times, if it's less than 3 months since the error happened, the only thing you have to contribute is really the employer match. You don't have to make that bonus contribution on behalf of for the missed participant's deferral. So that's kind of a lot of information relating to internal controls in your plan, but anytime, the best thing we can offer you is our support and guidance. So anytime, if you guys have any questions on, I really want to just, you know, get some things in writing, can you help us do that? You know, we'd be more than willing to. And again, if you're a Sikich client, we probably have already done that. You just may not have a written copy of what we have. So we'd be more than happy to provide that to you.
Thanks, Dana. We have a couple of questions here as we're wrapping up. Wanted to make sure we get back to folks. So if we do have a situation like you'd mentioned for the COVID pay or any other really pay code that should have been considered eligible 401k earnings and it was missed, what would the plan sponsor do to rectify that?
I think they would need to see if it's if it how many people were impacted by that. You know, was it just one person or was it a group of people? I'm assuming if it's something like COVID pay, it probably is going to impact more than one person. And since we are within probably a year or less since it happened, then what they would have to do is they'd have to quantify what amount should have been withheld from those COVID pays that were received, and then it more than likely it's going to be 25% of that will be deposited plus lost earnings into the participant accounts plus the employer match, if any, into their account also. But if they
Great.
wait to make any of those corrections, it would go up to potentially 50%. So
Great, thanks. Another one is if we have to amend the plan document to include the 500-hour rule. So I think essentially you will need to start amending that to make sure that you are factoring that in. The 3-year rule is actually going to be a couple years out, and you're going to do a look back to the hours that they worked in 2021, 2022, and 2023. So you should start to see the plan documents start to reflect some of those provisions. The prototype volume submitter environment that most of our plans are using, they're actually going to be going through the next restatement cycle probably, you know, within the coming year. Those next restatement cycles are going to be due sometime in 2022. I don't think that the majority of those are going to include these new provisions yet, but it's going to be something that probably the new documents will come out with one of those sort of blanket amendments that's going to need to apply to everybody going forward. There could be some opportunities to carve out a small portion of your workforce as long as you still pass your coverage rules as well with respect to those part-time employees, including those as well. We had another question about 457 plans. Those do follow, I think, a different set of rules as well. Most of what we're covering here today is a lot of the 401k and 403b areas. 457s could either be those of typically of a state and local governmental entity, or it could be some non-qualified plans and some tax-exempt entities too. So if there's a specific question on that, let me know, and you can send me an email on that one to clarify that. What about, Dana, if an employer had missed enrolling participants in eligibility to contribute? We've got this new potential requirement for including and offering coverage to part-time employees. You know, what would happen if we failed to enroll them timely, or there's any other group of employees? A lot of employers have auto enrollment if we miss auto enrolling somebody, or if we just missed getting somebody signed up, or missed an email from our record keeper that we didn't get somebody enrolled timely. What would plan sponsors do with regard to that error?
Well, first, I think you should always talk to their plan auditor or their TPA to help them. They want to see, you know, I think it depends too if you have auto enrollment, because the rules are a little more forgiving if you have auto enrollment. I don't know how that new, I'm assuming auto enrollment would still apply to those in the new category, so to speak. So it would really just depend on that, but you would be correcting it very similarly to how the missed COVID pay, depending on when you find it, it's probably going to be 25. If they, you know, choose to join at another time, it'd be their deferral times the missed wages times the 25%. So it would be a portion that would need to be paid into the plan on the for the employee deferral, and then the match, if any, would be at 100%.
Great, thanks for that. Going back to the another question about whether or not with respect to correcting contributions that are withheld on non-eligible compensation for terminated employees, do we have to make those corrections as well for terminated employees? Would that still apply, that those corrections are still required?
If they received, that's a really good question. And it's basically they received a contribution that they were not eligible for.
I think somewhere on the same topic, just what about if they're terminated employees? Because now we can't withhold from them going forward. So how do we fix contributions on that when we failed to withhold on eligible compensation, but the employees are
If you
terminated.
failed to withhold or you did withhold on an eligible, I'm sorry.
You fail to withhold on,
Even if they're terminated, you would still have to make the participant whole. So you would still have to make that contribution to their account, even if they were terminated.
yeah, I think the IRS actually has a really nice fix-it guide on their website where it walks you through in detail those provisions for that area. And I think that there is a requirement in the ability to not have to correct that they have to be actively employed still. And so then in that situation, you're probably going to have to make a corrective contribution to the participant where you essentially have to make up part of what they would have withheld. And you probably don't get the sort of the flexibility of not needing to fix it, you know, because they're not actively employed and that you just, they don't have the opportunity now to make up for those missed contributions. I think another one came in with regard to, you know, this environment where what if somebody's distribution gets taken in error, right? That another person got a hold of their password and money was distributed that the participant didn't receive, right? And what happens with regard to that? Dana, do you want to take that one or you want me to take that one?
Well, I think, you know, there was the case Estee Lauder had where there was a woman who there were 3 distributions from her account, and she actually notified the TPA saying, hey, I didn't make these. And I don't think they timely, well, I think after the first one came out, she notified them and they were looking into it, and then they kept taking more out of her account, and then ended up that they had the TPA and the whoever held their assets, I forget, had to make her whole. Again, on any of these errors, it's what you want to make the participant be as if the error never had happened. So I think it depends on, was it a cyber attack or how did they get her payroll and pass roll? You know, was it her kids, or, you know, was someone who has access if she writes them down, meaning you know, it was working, or was it someone who had no idea that just hacked in, got her password and requested it? So I think the precedent is that the TPA, whoever, you know, if it was more of like a cyber attack, it's going to be the custodian or trustee that would have to, but I think it's facts and circumstances. So I think in general, that would be who would have to correct it. What do you think, Karen?
I think it's going to be an evolving area with the attorneys that get involved, that people are going to point to that. I think that there's also an emerging area of just the cyber insurance that folks are getting. So it's interesting to be talking to your insurance broker as well as what type of cyber crime, you know, insurance they should be having, what types of things that's going to cover. So I definitely think this is going to be an area that's evolving over time, and whether or not these types of errors are included in those types of cyber theft policies that employers can get for coverage. I honestly don't know if this is addressed yet under those coverages. I don't think that it is, but as all these types of issues evolve, I think some of those insurance coverages will probably be, you know, catching up and continue to evolve what they cover as well. I think that's all the questions that we got in here today. So I appreciate, Dana, your time, and everybody for attending here today. If you do have other questions, you've got our contact information on the slides. As a reminder, for those of you who need those CPE or HR credits, please make sure you do the survey at the end of the presentation, or even if you don't need the credits, if you could share with us your feedback, we'd love to hear it. The good and the bad and the ugly too as well, and certainly what you'd like to hear going forward. But those certificates, for those of you who do need them, it'll take us a couple weeks to get those out to you. But again, thank you very much for everybody for joining this afternoon. Appreciate your time, and have a great day. Thank you.
Yes, thank everyone.